pricing. Obviously very important to the bullion industry. But you can't talk about pricing of precious metals without talking about spot price. Every kind of metal has its own spot. So there's silver spot, gold spot, platinum spot. Each kind, for example, of silver, each kind of silver will have its own price relative to spot. Spot price only refers to, let's just say, a chunk, a 1 troy ounce chunk of silver. Okay, it doesn't have any reference to what country it came from or who made it. It's just 1 pure ounce of silver. Future price is based on spot price, but it has to do with other factors they consider, like free rate of return, anticipated changes to supply and demand, and then of course obviously time to maturity. For the longer the contract, the more volatile it could be, so that affects future price. But the thing to remember here, bullion for the most part is traded in real time, meaning current price of silver, how much is it? Let's just say $20 for round numbers. That gives us the price of every kind of silver that we want. The bid price, the ask price, all of that is based on spot. Let's dive into it just a little bit more. I made this chart. It's not supposed to be extremely accurate, just for illustration purposes. Let's say silver spot price is $4. It's 1 o'clock in the afternoon, and silver starts to move. So what does that do to a silver eagle? What does that do to a panda? What does that do to a 100-ounce bar? Each kind of silver has its own price above spot, and that price is called the premium. So in this scenario, we'll take a look right here at the beginning. Silver spot price is $4. The silver eagles trade at $2 above spot. So if you wanted to buy a silver eagle at 1 o'clock in the afternoon, it's going to cost you right at $6. A silver panda, it's a little more of a rare coin, a little harder to come by, so that panda will trade at a higher premium. Okay, so it looks like it's around $7 a coin higher. Typically the premiums are indicated by a dollar amount. Here in the US, a dollar amount over spot. Gold will typically have both a dollar amount over spot or a percent over spot. So a silver eagle might be $2 over spot, but a gold eagle might be spot plus 2.3%. So each kind of metal has its own spot, and then each kind of metal also has its premium above spot. So in this case, silver eagle premium $2, silver panda $7. A 100-ounce bar, for example, of silver, we just recently traded those at 15 cents over spot. And that's because it's a lot easier to make a 100-ounce bar than it is to make 100 silver eagles, for example. So that 100-ounce bar will trade closer to spot. Now the flip side to that is called the buyback price. Premium is the above spot price. The buyback price is if you were to walk into a gold and silver shop, if you want to buy a silver eagle above spot. If you want to sell a silver eagle to them, they'll typically give you below spot price. The premium would be $2. In this example, the buyback would be $2 below spot. Premium is above, buyback is below, and the difference between the premium and the buyback is known as the spread. A lot of people get premium confused with spread. Premium is the difference between the price that it costs you to buy it and spot price. So the premium for that eagle would be $2, but the spread is the difference between what you pay for it and what they will pay you for it. So that's the spread. And a good rule of thumb when you're out there buying precious metals, the smaller the spread, the closer they are, the premium and the buyback, the better it is for the customer. So premium is above spot, buyback below spot typically, and the spread is the difference between the two.